Hello everyone, welcome back to Fundrise Finance. In today's video, we are going to talk about index funds. That should be at the core of your portfolio so that you can weather any market condition. Let's check it out. According to Investopedia, an index fund is a type of mutual fund or an ETF with a portfolio constructed to match or track the components of a financial market index such as the S&P 500. As we discussed in our earlier video, the entire stock market consists of more than 4,000 companies. These are divided into large, medium, small, and micro categories. Let us understand what these terms mean. A microcap is a stock with a market cap of between $50 million and $300 million. These companies are fairly new and their earnings are not yet established, so they are pretty volatile and riskier. Few examples in this category include Ashford Inc., First United Corporation, and Salem Media Group. Moving on to small cap, they are generally companies with a market capitalization between 300 million and $2 billion. They typically have higher growth potential but are also volatile, so you need to be really careful. Few small cap examples are Fulgent Genetics, CTO Realty Growth, and Omnicell Inc. Mid-cap companies are those with a market cap between $2 billion and $10 billion. Few mid-cap examples are Williams Sonoma, Dick's Sporting Goods, and Choice Hotels. Moving on to large cap stocks. These companies have a market capitalization more than $10 billion. These stocks form a significant portion of the US equity market and are often used as core portfolio holdings. Few large cap examples are Pfizer, Morgan Stanley, Texas Instruments, and Lockheed Martin. We also have mega cap stocks, which are companies that have market capitalization of more than $200 billion. Many companies in this sector have a strong brand recognition and operate in many countries around the world. Few examples include Apple, Amazon, Alphabet, Meta, and Tesla. Now that we know what different market caps are, let's look at how the whole US equity market is divided into these. If you have liked this video so far, please give a like so that this video gets recommended to many others. And also, please subscribe to this channel if you have not done already and click on the bell icon so that you get notified of any new videos in the future from me. Major US market indices are defined either by Standard & Poor's, in short S&P, or Russell. S&P defines the top 1,500 companies of the market into three areas. The top 500 being the S&P 500, which we discussed in detail in our earlier video. The next 400 is the S&P 400, which is the mid cap. And after that, 600 small cap companies, that is the S&P 600. So if you see here, large caps, which is the S&P 500, makes up 79% of the market. Mid caps, 7%, and the small caps, 3%. Now, if you look at how Russell defines the market, is it considers the top 3,000 companies in the market and splits it into two categories. One is the Russell 1000, which almost makes up 89% of the market, and the remaining 2,000 companies as Russell 2000, which are basically the small caps, and that accounts to around 8% of the market. Knowing about these indices is very important because as you keep looking at your ETF investments or your mutual fund investments, there's this key term there which says benchmark. So let's say if we consider the S&P 500 ETF, WU, which considers S&P 500 index as your benchmark. So if you look at a term called total stock market index anywhere in your investment, that means that particular ETF or mutual fund is trying to capture the performance of the whole stock market of roughly 3,000 plus companies. Now, let us go over the ETFs that track each of these specific indexes. Starting with the S&P 500 index, let us now go over some of the key ETFs in each of these market caps. Starting off with the S&P 500 index, we have SPY, which is the largest ETF in the world. This is managed by State Street. It has an expense ratio of 0.09. That means for every $1,000 that you invest, around $9 is charged as an expense ratio. So it's already deducted from the fund cost. So it's not that you're paying the cost afterwards. This fund manages almost $410 billion worth of assets. And if you look at the top holdings of this ETF, they're all the mega caps, the Apple, Microsoft, Amazon, Alphabet, Tesla, and so on. In my opinion, a cheaper and better alternative to SPY is WOO from Vanguard, which only has 0.03% of expense ratio, which is for every $1,000, you're just paying a meager $3. We also have IVV, which tracks the S&P 500 index. It also has an expense ratio of 0.03%. Moving on to the mid-cap space, the popular ETFs here are IJH from BlackRock, which tracks the S&P Mid-Cap 400 index. Even this has a very less expense ratio of 0.05%, so which is $5 expense for every $1,000 invested. And if you look here into the portfolio, this is all the mid caps below the S&P 500. We also have SPMD from State Street at the same expense ratio. And from Vanguard, we have IVOO, just slightly more expensive at 0.10. So all these three ETFs we saw till now for the mid cap track the S&P mid cap 400 benchmark. But Vanguard also provides another ETF, which is VO, which is very popular, and this tracks the crisp US mid cap index, and that has a much lower expense ratio of 0.04%. Now, moving on to the small cap space, here we have IJR from BlackRock, SLY from State Street, and VIOO from Vanguard. All these three ETFs track the small cap 600 index. And again, Vanguard also offers VB, which tracks a different index, which is the crisp US small cap index, and has a lower expense ratio of 0.05%. When this is a very popular ETF. Now, finally, moving on to the total market space. So here, when you say total market, it is the entire stock market where these ETFs purchase the entire stock market of 3,000 plus companies at once. In this space, the most popular ETF is VTI from Vanguard. The reason being, it has a very low expense ratio of just 0.03%, and you own more than 4,000 companies with just one ETF. Let's see the composition of this ETF. For that, we go to ETF.com, and here we see this ETF getting an A rank, 98 out of 100. And we scroll all the way down, and we see the composition. It has 87.5% in large cap, almost 10% in mid cap, and 2.5% in small, and the remaining in micro. We also have a mutual fund version of this ETF from Vanguard, which is VTSAX. Fidelity also provides a similar mutual fund, which is FSKAX. It also provides a zero cost total market fund, FZROX. As you can see, expense ratio is 0.00. But a key difference being it tracks Fidelity's own US total investable market index, which is different to what VTSAX from Vanguard or Fidelity's own FSKAX do. As you can see, FSKAX has almost 4,000 holdings, whereas FZROX has 2,600 holdings. But the performance of both of these funds has been fairly same. So someone who has an account at Fidelity should consider FZROX as one of their options. In the ETF space, another total market ETF is ITOT from BlackRock. The best part a total market ETF does is not only gives you the returns of the S&P 500, but also a possible future returns from the mid and small companies. So like we saw in VTI, Your 88% is in large cap that's been driven by your S&P 500, and the remaining 12% are from the small caps. This is important to observe because there are a few companies over time which start off small but grow quickly into large cap. A classic example being Tesla. Tesla was not part of S&P 500 before. It was a small cap stock, but over the years it just kept growing and growing from a small cap to a mid cap into a S&P 500 stock. It joined S&P 500 in December of 2020. Till then, any investor who was just investing in S&P 500 fund would have missed the meteoric rise of this company. But by owning an ETF like VTI, which focuses majorly on the S&P 500, but also on the small cap segment of the market, you are able to get some benefit out of it. One key thing about all these ETFs that we have spoken so far is that they are passive, which means they just track an index. The index defines the stocks, and these funds or ETFs buy the companies or stocks based in that index. On the other side, we have active investing, where the fund managers are trying to beat the market by constantly monitoring how the market is doing, which sectors are doing good or not, and accordingly moving their money around. That needs constant monitoring and more involvement. So those funds usually cost much higher than the passively managed funds. But it has been proven over time that passive investing beats out active investing. So unless the actively managed fund or ETF is able to provide excellent returns over and beyond what a passive one would provide, there is no special case for anybody to consider an actively managed fund. So that's it for this video. Hope you all got to learn about the market, the indexes, and the various funds one could make use of. Thanks for watching. Please leave a comment about how you felt watching this video and if it was really helpful. Please like and subscribe to my channel to keep informed about all such informative videos in the future. I'm not a financial advisor, and all the content you would see in this channel is for educational and entertainment purposes only. Everyone should do their own due diligence before investing their hard earned money. Thanks. Bye.